Want a foreign holiday, a second house, a new car? The only thing stopping you is the prohibitive price tag. That's not really a problem. As you can see, lenders are falling over themselves to offer credit to everyone and anyone. Loans are being offered on the phone, through emails, and even WhatsApp messages, tempting borrowers with easy availability and convenient repayment options. While borrowing is necessary and even recommended in certain situations, one must do this with caution and within reasonable limits. So in the next few minutes, we will discuss the 6 thumb rules that you should keep in mind while applying for the loan and how to be a smart borrower. Thanks, Babar, for joining us.
Thank you, Saurabh. Always a pleasure to be with ET Online.
So your first thumb rule, according to your main story, is don't borrow because you can. Please clarify.
Your loan to income ratio should not be more than 35%. What is the loan to income ratio? It is your total EMIs divided by your net monthly income. So if your net monthly income is 50,000 rupees, your loan repayments in the month should not exceed more than 15 to 17,000 rupees. That is 35%. Now, if you are below that 35% mark, you are in a comfortable position. But beyond 35%, it gets alarming. It gets, troublesome, and you feel the stress. If it goes beyond 50%, you are in an alarming position. Now, when I say net monthly income, that includes if there are, if there is spousal income also, spouse is also earning, then there's a net household income, not the net individual income. Your net monthly income is what is available to you, to the family to spend.
So there is an option of people say prepay as early as you can, but in cases of say home loan where you get a tax benefit, and for education loan, is it the best option? And is it the second thumb rule that you have talked about?
If you have taken a loan, or if you have existing loans or you're planning to take a loan, take for the shortest period. And even when you take it, try and repay as fast as possible. When you took a loan, when you take a 10, 20-year loan, in the first year, the EMI is maybe a big chunk of your net monthly income. But that EMI remains constant, whereas your income keeps on rising per year. So as your EMI is a percentage of your net income, will keep on reducing as a percentage. If you get some bonus or something, yes, you want to spend it on your family, you want to buy new things, yes, do that. But take some money out of that bonus and prepay your long-term loans. As a rule, you should first pay off the most costliest loans that you have. Obviously, the costliest loan is a credit card outstanding. That you should anyway repay as fast as possible on the day when the bill becomes payable. And personal loans are very expensive loans. You should try and pay those loans as fast as possible. Some loans are cheaper loans, like home loans and education loans are cheaper in the sense home loan will anyway have a very low rate of interest because it has a collateral. You've given 1 crore house papers to the housing finance company and you've taken a loan of only 40 lakh. So obviously you're not going to run away, and it's a safe loan for the company. But the government also gives you tax benefits on that loan, which brings down the total cost of that. It's not 7%. In the 30% bracket, a housing loan, which is if it's at 7.5%, it will cost you actually only 5.2% in the 30% bracket because you get tax benefits on it. Effective home loan rate in the 30% bracket, from 7.5%, it comes down to as low as 5.2%. Having said that, keep in mind that, your income has gone up and you have more surplus money to maybe prepay that loan. If you do not have any other investment options before you, maybe the best idea is to prepay off that loan. Making prepayments can have a dramatic effect on the loan tenure. Suppose you took 50 lakh loan at 7% for 20 years. Your EMI comes to around 38,765. If you increase that EMI by 5% every year, your loan gets over in 12 years only, 12 and a half years. Instead of 20 years, comes down to 12 and a half years. If you increase the EMI by 10%, you can be out of the loan in less than 10 years. So a 20-year loan can actually be finished off in 10 years.
So if we go by this thing, you should first start with your credit card. If there is any outstanding on that, then you come to personal loan, and then you come to a car or a house, a car or an auto loan. And then the last one could be your home loan, which is the
education loan or home loan, because education loan also gives you a tax benefit. However, education loan rates are a little higher than home loan rates.
So basically, the easier it is to get the loan, the more expensive it is.
Yes.
That's another thumb rule that we can say.
Yes, the easiest loan is your credit card. Whenever you swipe your credit card, whatever you spend is actually a loan, right?
Yes.
It is interest-free for till the next billing cycle. But beyond that interest-free billing cycle period, it becomes the most expensive loan. If you haven't repaid the entire amount, you will be charged 3 to 4% per month. That turns out to be 36 to 48% per year.
So, given the fact that recently RBI has been on a rate hike spree, and I think it's going to continue for some time, what would you suggest as the third thumb rule for the investors?
Since rates are going to go up, why not move from a floating rate to a fixed rate loan? Yes, moving to a fixed rate loan is a good idea. However, keep in mind that fixed rate loans are 100 to 150 basis points, that's 1 to 1.5% more expensive than a floating rate loan. Now, if the difference between your floating rate and the fixed rate is beyond 150 or 100 basis points, then it won't make too much of a difference. You won't save too much because you will be also paying something for refinancing that loan.
So another thing that recently a lot of Demat account holders and the new people who have started investing, they have started taking loans to invest. What is the thumb rule regarding that? Is it a good option?
The first rule of investing, one of the very important rules of investing is that you should invest only what you are willing to lose. That means you should be investing surplus money in the markets. Lending rates will always be higher than deposit rates. So if you've taken a loan to invest in fixed deposits, it doesn't make sense at all. You'll be earning less on a fixed deposit than what you will be paying on the loan. But that's not what people do. People borrow money to invest in the markets, in the equity markets. And that's simply not recommended. You should be investing only money what you have already. What is your surplus? That should be going into the markets, not borrowed money. So don't do that. Don't take a loan for investments. So one thing that loan salesmen try to give you the wrong impression is by telling you about the flat rate applicable to your loan. Flat rate is not relevant when you are paying in EMIs. Flat rate is relevant only when you pay at the end of the loan tenure lump sum interest. Now the flat rate, suppose you're taking a 3-year loan, they will say that the flat rate is only at 10%. But actually it comes out to 18% on a reducing basis. flat rate 5.4%, but actually it comes out to be 10%. Don't get conned by the salesman saying that the flat rate is very low. Why don't you take a loan and invest in the markets where you can earn higher? You should look at the effective rate from the reducing rate basis, not from the flat rate basis.
So, Babar, many a times it happens that one of the primary earning member, he has a lot of loan upon him. And at times it happens either there is a job loss, or if there is some medical emergency in the family, and God forbid if the person passes on. So what would you recommend for those borrowers who have these kinds of loan, and what should they do?
Firstly, one should have enough insurance in case something untoward is to happen to him, especially for, as you were saying, primary breadwinners of the family. Even more important than primary is the sole breadwinner. If he is the only earning member of the family, he must have enough insurance. Now that insurance should take care of replace his income. But what happens if he has replaced his income, but he also has a huge housing loan, a big ticket loan he's taken a big ticket loan? What will happen if something happens to him? The family will be asked to repay that loan. Now, lenders, we saw in COVID a lot of people passed away, leaving behind their families with huge home loans. What will happen is lender will take a sympathetic view. They will not waive off the loan. You have to repay. They might give you, 1 month or 2 month kind of, okay, arrange for some loan, arrange for the money, but they will be expecting you to pay the EMIs on time. So always, whenever you're taking a loan, a big ticket loan, take an insurance policy along with it to cover that loan. If something happens to you, that cover will be separate from the other cover that you've taken to protect your income, to replace your income if something has happened to you. वो अलग है. That is separate. That is for sustenance of the family. This is for settling of the loan.
So the life insurance loan is different, and this is for the sustenance of the loan.
This is for settling the loan. This is also a life insurance.
Yes.
But this is for settling the outstanding home loan. Now, this is not very expensive also. A 30-year-old man, if he's taken a 50 lakh rupee loan and he takes a 50 lakh rupee cover with it, you know how much will be the premium for 20 years? The premium will be only 6,000 rupees per year. Or he can do one thing. Instead of paying per year, he can take he can make a one-time payment. That's a single payment plan of 67,000 rupees. So instead of 50 lakh loan, he should take a 50 lakh loan plus 67,000 also. So that 67,000 will ensure that if something happens to him in those 20 years in which he has to pay back, it will be taken care of. By paying that 67,000 rupees more at that time, he will be able to ensure that his family lives in security if something happens to him. At 40 years, he'll have to pay 12,000 rupees per year, but around 1,35,000 at one go. At 50 years, it will be 28,000 rupees per year, but 3 lakh rupees at one go. Even so, it's expensive at older ages, yes, but it is very necessary.
And let's come to your last thumb rule for the smart borrower.
Smart borrower, one of the rules of smart borrowing is that taking a loan is not a good idea unless you really need it. But sometimes taking a loan is better than dipping into your finances. That is when you're taking an education loan or for your children, and instead of taking a loan, you think that why not dip into my PF or other retirement savings. Parents get emotionally charged by when they are saving for their children's education or paying for them, that they often use up their retirement savings for their children's education. It's a good thing to do, very noble ideas, but if you are going to dip into your retirement savings, just keep in mind that it will compromise your retirement when you are old. Your child may be able to get an education loan. You will not get a loan for funding your retirement.
So there you have it. These are the 6 thumb rules that you should keep in mind while applying for loans. I hope you like this video. We'll keep on doing more such videos. Please give your inputs in the comment section. Thanks for watching.